Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Strategy Update for Friday, July 28th. Well, since our last update, the market action has been strong. We've seen continued expansion of market participation. We've been talking about seeing that developing over, say, the last 2 months or so, and that certainly has continued since our last update. For a while there, market action was very limited to just a handful of the biggest companies. We were concerned about that for a while, but that concern now has been alleviated. So in this update, we're going to show you some of our breadth indicators and the progression that's taking place there. And we'll also spend a bit of time talking about the economy and how things are or could be developing on that angle. Well, bringing up our proactive asset allocation dashboard, really no significant changes to speak of. Everything looks very similar to how it looked the last update. We do want to take a look at our universe trend indicator because that's where we're seeing some continued progression in the expansion of market participation. So here is our key breadth indicator. We have others that we look at as well, but this is the one that's really part of our market model. And the improvement we're seeing is noted by adding that 7 in this rising column. So that indicates that we've seen some further movement. For a while there, the breadth had gotten stalled out. Once we hit the bottom in October last year and started to turn up in November, there was some good participation in the market in those first few months of this uptrend. And then as we got into February, everything just kind of hit a wall or a ceiling, and the breadth stopped improving. And in fact, we saw some pullbacks. Over on this chart, we saw this drop in breadth in March. Well, now, the latest action is very encouraging because we're seeing that expand, and we now are above the February high. So more breadth participating, more industry groups, more stocks participating. This is a positive sign for this particular market cycle. So looking over the dashboard, all the core indicators are positive, and that's a great sign. Tactically, we're beginning to see things get a little bit stretched and perhaps getting to an overbought level. The Dow had just completed 13 straight days of being up, which is unusual. So markets, don't grow to the sky, and generally speaking, even during bull markets, things could get stretched and overbought and put a lid on, at least a short-term lid, on further advances in the near term. So here's our overbought, oversold indicator, and we're looking at a time period that starts with our global buy signal in our market model, November 30th, and goes to current. And you could see that we're now up to the upper end of the channel. This is the bull trend channel that we expect the market index to trade in as long as we remain in a bull cycle. So when we get to the overbought area of the market, it does create a bit of inability for stocks to continue to push higher, limits that potential in the near term. We still think that we're early in this market cycle, too early to be concerned about tactically selling. We really haven't seen much in the way of corrections this year. We had, one there in February, March timeframe coinciding with that mini banking crisis. But at that time, stocks weren't overbought. We were more at the average and came down to the lower end of the channel. But now we've moved to the upper end of the channel, which does create more air underneath the market if any negative news were to hit, or stocks were just to stall and maybe stumble a little bit before making further progress. If we do see a correction this year, we're approaching the time when it would most likely happen. August and September seasonality is less favorable, much less so than what we've experienced really going back to the midterm election. Seasonality was very strong right after the election into the earlier half or so of this year. Now seasonality is less favorable. Not that it's necessarily negative, just less favorable, and that sometimes does influence market movement. Now, the correction we did see back here, say in February and March, was a catalyst for rotation in market leadership. So about a 4-month period from the beginning of February through the end of May when the mega cap tech stocks were the only game in town at the expense of just about everything else. We talked about that quite a bit during that time, and we were concerned about the narrow participation of breadth, and that if it didn't expand, it could lead to an end of the market rebound coming off of last year's low. Well, that changed about 60 days ago, and market participation is expanding. The expansion of breadth is positive, and we're more optimistic about this market cycle. We've seen more industry groups participate. For example, the energy and financial sectors have been some of the stronger areas in recent weeks and months. That's more the value side of the market versus the growth side. Small companies also are participating more now. It was just a couple of months ago that the small cap indices were still near their 2022 low, but that's not the case anymore as they've lifted up quite a bit in the last several weeks. Commodity prices have firmed up significantly. Oil's back near $80 a barrel. For a while it was in the 60s. We're seeing gasoline prices go up and agriculture commodities, etc. So all this speaks to money moving to more areas and more assets and not as narrowly confined to the mega cap growth stocks. Those stocks are still doing well. However, they're not the only game in town anymore like they were for this period of time. So from a market cycle perspective, things look good and are improving. The uptrend could stall and even correct a little bit as we move into late summer, early fall period. But the expanding breadth that we've seen recently is a positive. So while the market model we use is based on capital market data in the equity markets, momentum, breadth, and trend analysis, etc., our other model is based on economic data. And that one is telling a very different story. Just to give you a visual and bring up our economic model, it's been pointing down for just about a year now, just short of a year. It was last September that we told you we officially have a recession warning. Now, this model doesn't speak often, but when it does, we should pay attention. It being negative for several months and a recession not developing yet is not unusual. All we have to do is go back to the '08 time period, and you could see the long leading indicator turn down. Going back even into 2005, the economy didn't peak, or I should say the stock market didn't peak till October of '07. The leading index usually is more timely. That turned down at the beginning of '07. Again, the stock market peaking in October of '07. So this lead time is not out of the ordinary to warn of a recession. So with our models diverging, our market model positive, our economic model is negative. First, this is unusual, doesn't happen that often. Really the last time was back here during that previous '06, '07, '08 cycle. But typically when that happens, we want to have a barbell approach for this cycle with about half of portfolio money invested in growth assets that should appreciate if a broad market advance continues to develop as it has been now, was at the beginning of the cycle and once again is. The other half of the strategy is in a recession portfolio, assets that should perform well in a recession. But until a recession starts to matter to the market, this part of the strategy could be a drag on the growth side, and so far has proven to be a drag on the growth side. Now, why would we do this? Because conditions can change rapidly if a recession develops. Stocks tend to peak 3 to 6 months before a recession develops. You go back to the '08 period, stocks peaked in October '07. According to the NBER, National Bureau of Economic Research, the recession started in January of '08, so it was right at that 4-month period ahead of time. Of course, they didn't tell you that until a year later, so we can't wait for the government to tell us we're in a recession to know that we're in a recession. We need something that's forward-looking and alert us to that potential recession in advance for it to really provide any value in risk management during a recessionary period. So holding the recession portfolio is important because growth assets can give up gains quickly in the early part of a recession. Meanwhile, the recession portfolio, assets that should perform well in the early part of a recession, will help stabilize market values during such times. It's a drag until that time, but adds value during the early months of the next downturn. Not every risk is worth taking. This market condition is one of those times that we believe it pays to approach cautiously, even if it means giving up some opportunity for a period of time. Eventually, we will be rewarded with having that cautious approach when conditions change. So the obvious question, of course, is when will conditions change? And while I don't think anybody has a good handle on the timing of a recession, we could take a look at some evidence that things underneath the surface maybe aren't as they appear on the surface. So this week we were part of a presentation from a very well-known and experienced economist, and he shed some light on a few areas that I found helpful, and I wanted to share those with you today. So this is a slide as part of that presentation, and there's a lot of numbers on it. What I want you to focus on is this first column here, real GDP. This is what is reported. In fact, just this week, the second quarter of 2023, GDP number was reported. It was a positive 2.4%. Business News celebrated that as a very strong economic number. Real GDP is actual GDP minus inflation, right? So actual GDP is considered nominal GDP. That's the actual production in the economy. So you could see it was 4.7% this last quarter, but look at the progression over the last year or so. This time last year it was 8.5%, and it dropped into the 7s, the 6s. Now it's down below 5%. So the rate of change in the actual economy is dropping, but inflation is also dropping, and they use this thing called GDP deflator to record inflation on a GDP level. So that was 9% a year ago, and this quarter it was only 2.2%, or last quarter I should say. So what we've really seen isn't necessarily an improvement in the economy, but a drop in inflation, causing the real GDP number that the media focuses on to appear strong. But underneath the surface, we're definitely seeing the rate of change moving lower in the actual economy. Well, now, why does all that matter? Here's a good chart that shows the various cycles and how one leads another cycle. So there's three cycles. There's the financial cycle, which is what the Fed is doing with monetary policy. The GDP cycle, which is the actual economic output in the economy. And then the labor cycle, which, of course, we're hearing how great and how strong the labor market is, and it has been, but that generally is the last cycle to turn lower. So the peak in the financial cycle probably occurred in, let's say, March of last year. That's when the Fed started to raise interest rates. So we're maybe 15, 16 months into that cycle. Some would argue it started a little earlier because they stopped pumping money into the economy a little bit before then. But somewhere in that range, let's say the fourth quarter of 2021, maybe into the first quarter of last year. Usually that's followed by a peak in the GDP cycle, and that's the chart we just looked at. And you could see how that probably has peaked at 8+% in the second quarter of last year, and now is down to 4%-ish in that range. So as the Fed has pushed interest rates up and the financial cycle is dropping, we eventually would expect to see the economic cycle itself to start dropping, and some slack in the labor market, and maybe even some job losses develop eventually. And typically that's not good news for stock prices, and we would expect to see a decline, and maybe a significant decline, if that type of economic cycle does develop. And lastly, I thought this look at interest rates. The Fed funds rate is the rate that the Fed controls, and this is the real Fed funds rate. So just like there's a real GDP after inflation, this is taking a look at what the Fed funds rate is after an inflation adjustment. And one thing that points out is where we are today, that red dot. In fact, we could extend this up one more level, I believe, because the Fed raised interest rates yet again just this week. So when we take the current level of the federal funds rate and then subtract the inflation rate from it, we're probably something like 2.25%, somewhere in that range. Well, you could see not too long ago at the depths of COVID and all the Fed stimulus that came into the market, we were at a negative 5% of a real Fed funds rate, which is extremely stimulative. This is now becoming more restrictive. And one thing that becomes obvious is that peak in the real Fed funds rate tends to occur ahead of recessions. So the question is, are we at that peak? Or maybe there's another rate hike to go. Maybe there are a couple more rate hikes to go before that peak. We don't know. Another way that the real Fed funds rate could peak is inflation could start to go up again, causing the real Fed funds rate to drop. And finally, I thought this information was very interesting look at the federal government spending and how the Fed supports that at certain times but does not support it at other times. So this first column is the fiscal deficit. That's our federal government annual deficit. Pre-COVID, we were about $1 trillion. COVID year, over $3 trillion. 2021, close to $3 trillion. It dropped to $1.4 trillion last year. But even through the first 9 months of this year, we're at $1.4 trillion. So our deficit is going up in 2023 over 2022. This column, number 5, is all the Fed purchases. And you could see positive, highly positive in 2020 and 2021, winding down in 22. Now it's negative. They're draining money from the economy. So while the federal budget deficit was highly negative through this period, the Fed was financing that for a period of time. Now they're not. And so what that causes is this number right here, and that's funds drained from the private non-bank sector. That's you and me, and it's our corporate sector. So money is coming out of the private sector where it's more efficient, moving to the public sector where it's much less efficient and has a lower multiplier effect. So while it's taking a while for the economic model and the warning there to have an impact on the economy, it's all still alive and well. And all of these numbers and statistics we just went over eventually should have an impact on the economy, and that, of course, will have an impact on the stock market, which is why we continue to have our economic model as a key part of our decision-making process, only when it's speaking as loudly as it is today. Well, that's going to wrap up this update. I hope that you enjoyed it and received some good information. Have a great weekend, and we'll talk to you in a couple of weeks.